and welcome everybody. This week we're going to be talking about Property Sentiments Report, second quarter of 2023. Now, most of this information I have sourced from one of the magazines that we follow, the Australian Property Investor. Great magazine, fantastic insights. We get their updates on a weekly and monthly basis. And I just thought that it was just packed with such amazing information for this quarter that I'd love to share it with you. I've asked my good friend Mark Navin to join me, and we're going to have a general chat about what's in this report. So Mark Navin is a buyer's agent in the residential space. And the reason why I've asked him to join me is these reports are pretty much put around residential property. And as I've said 1,000 times before, commercial is really a knock-on effect of residential. So it's always very good tracking the residentials before we go to commercial. So Mark, thank you for joining me. Welcome to our little show where we're going to bang out some stats and some numbers.
Thanks very much, Mish, and thanks for the invite and having me on the show. It's very exciting to be talking about some of this stuff. And I think these sort of reports and ideas about market sentiment, plays a huge part in what the market's actually doing, regardless of it's whether the buyers want to actually buy or not. So it's important to understand what's going on.
Absolutely. Very much so. And I think the media plays a big part of market sentiment as well. So just to articulate, this report was done, as I mentioned, by the Australian Property Investor group, and they did a review with around about 735 people, subscribers to their platform. So these are people who are investors, non-investors, people that are interested, and the likes thereof. So I think it pretty much sums up quite a good overall of
good selection. Yeah,
yes.
Good selection. Yep. Now, people will often focus on housing first because they're wanting the land content. The traditional view has been that houses get better growth because of the land content than what a unit would. But what I've noticed happens when the market starts to grow, houses will get to a certain point, prices will rise, the yields will therefore come down if the rents aren't going up at the same time. So the yields will become lower, and then people will start to turn it back towards townhouses and units and go, well, look, I can buy 2 of these for the price of 1 house. And they offer such a great rental return compared to a house. So then investors start to look at these and they become very attractive. And then
are you starting to see that in the market now?
I've already seen that over the last year. So housing had a really good run, and units really did nothing during that COVID period. That COVID period came, all the lockdowns sort of came to an end, and that's when we started to see that. So let's say in certain parts that I'm buying in, we could buy houses at sort of 500,000, but I was still picking up, cheap townhouses for 180, 190, 170 in some cases, and so less than construction costs for them. You could buy literally 2, almost 3 in some cases for the cost of 1 house. And they were, getting, in between sort of 7 and 9% gross return.
Wow. Okay. Well, that's incredible to hear, because I've been hearing that in the residential space on a number of platforms. And I guess it's a little bit similar to commercial, where you talking about townhouses or units. We always regard a sort of high-end or high double-story high-rise office space is very similar to units, where you're buying into, you really are just buying a hole in the wall, so you're not buying land per se. And one of the biggest drivers in commercial since COVID has been that land component. Everybody wants land.
Yes.
So it's kind of probably followed the same sort of thing, but I think the housing market has been a little bit more aggressive in that space where there's a housing shortage. So hell, if you can buy units for 130 or 170,000, you've got tenants.
Absolutely. That's sort of shifted now. We're pretty much sort of at that 250K is the bottom of the market for those sort of townhouses, generally speaking. So
Yeah.
you can see that big jump in the growth there. But do you think, Mish, with when you were sort of talking about the land content for commercial, do you think that does the type of tenant has that sort of played a big part over that COVID period of the type of tenants that what they're looking for and what they're looking to do with the properties?
Very much so, because in the commercial space, you've got a hell of a lot of owner occupiers. So what's happened is the investor stock has pretty much, I don't want to say it's dried up, but there's more of a demand on investor stock, because a lot of owner occupiers are sitting up and saying, hey, you know what? I've got my self-managed super fund. I've got money in my self-managed super fund. We've saved squillions during COVID. I'm paying somebody else rent. I might as well just buy my own warehouse. You know, so we've seen a huge impact in the commercial space of owner occupiers coming in and snapping up those, those little units. So almost,
I know quite a few business owners buying in their super fund as well.
Yes,
Yeah.
huge. Yeah. So, and a lot of people, I think, saved a lot of money, saved a lot of cash during that COVID period. And now they're saying, the property market, it hasn't stopped. It's still on a massive growth rate, and we can have a look at some of the numbers as we go through. We're going to show you those charts. Very interesting what we've got, the transaction intention chart on screen at the moment. We're looking at a higher rate of buyers that have come in. So 28% more buyers, and you've only got 12% sellers. So automatically, that puts a massive strain on housing. There's a shortage of housing.
Absolutely, yeah. And look, I mean, it's good to see like the stats like this as well. But I'm sure both you and I are seeing the same thing when we're out there negotiating properties, and you get like that. You got your finger on the pulse of what's happening on a day-to-day basis. And this is exactly what we're seeing, that there is a massive shortage and a shortage of quality stock too.
Yeah. So just to be clear, the graphs that we're looking at, again, it is residential, but I'm seeing exactly the same sort of things happening in commercial. In commercial, in fact, the demand of buyers, we've got 53% buyers, more so than what we have of properties, of sellers. Wow. So we've got around about the same rate of sellers, 12% sellers, 53% of buyers, and most of those are either owner-occupiers or investors.
Yeah, everyone's sitting tight at the moment.
And everybody's sitting tight, and you know what? As a property owner, I mean, I'm feeling the same thing. We get offered offers on our properties all the time, and our properties have just gone up and up and up. And I'm saying, well, why should I sell? I've got to pay capital gains taxes, and where am I going to buy? Because I might as well just stay in the buying lane and carry on buying with everybody else. I'm not going to be selling right now. It's not a time to be selling. It's interesting, though, that a lot of people are still hunting those renovation flip deals. So you've got 11% of renovations. Syndicates have come up as well. So where people are buying in syndicates. So we've run into that quite a lot, and I can see that the syndicate space in commercial it's doubled, if not quadrupled. And
low barrier to entry too, I guess, is maybe one of the attractive parts, would you say?
Pretty much. I mean, it's depending on the asset itself, who's running it, and what it's all about. So yes, it would be a low barrier to entry, depending, again, like I say, whatever the fund is. In order to do that, you have to have funds, and there are various different small groups that REITs and that can be doing that. On this chart that we're looking at 28% buyers in residential, where you've only got 5% in commercial. So it really is. There's still that many more. 23% more people are still buying in residential than they are in commercial.
I thought that would have probably or possibly been a bit higher, because I know that commercial has really gained a lot of traction in probably the last, maybe 3 or 4 years, more so than ever before. I thought it would have been
It
a bit higher.
has. It has, and we'll see a little bit more about that in some of the other graphs. But bearing in mind, we're talking about a traction that was maybe around about 2%. That's now gone to 5%. So,
Mm,
in the greater scheme of things, 5% is quite substantial. And we're seeing so much activity in the residential market. And like I mentioned before, I'm sure you'd know more about this than I do. All I can see is a couple of people that I know that have been trying to buy residential properties, owner occupiers, obviously more so for
mm.
themselves, and having to wait 12 months, 14 months, 15 months before they can actually find something that is suitable at a marketable price for them, or let's call it an affordable price, because all the areas have gone up substantially as well.
Look, absolutely, prices have gone up, but like we sort of touched on before, people are just sitting on the properties that they got. Not a lot of sellers on the market. So to find the right property that you're looking for, and there's a lot of competition out there too. So that's, as an owner occupier, people are missing out constantly, and a lot of people give up because they're like, well, I can't find the right place. I'll just go back to renting, or just not sell and stay where I am, because it's too hard to get to that next property as an owner occupier. Unless, I know a few owner occupiers have done like a rent back or a long settlement to give them a bit more time to find that next property. But it's yeah, it's difficult. I wouldn't like to be looking for a property as an owner occupier where you're buying with your heart and emotion. You want the right property that's going to suit you, and you just don't know if it's going to be out there. From an investment point of view, it's super competitive as well. There's a lot of investors. If it hits the market, it still is going to multiple offer. It may not be as crazy busy as it was during that COVID period, but it's still a busy market. It's still what you'd call a seller's market.
Very much so, and I'm finding that in commercial as well. And it's interesting, the statistics that have come out from the Australian Investor magazine article is they're saying that commercial sellers have decreased from 10% to 5%. So what's that done to the stock, and what's that done to the demand? Again, it has just forced that demand up incredibly. It's basically doubled the demand. And this is what I was saying. We have 53% buyers and minimal stock.
Yeah.
So it's
So
as a result,
demand is up and supply is down.
yeah,
We're moving on that sort of upward
trajectory.
direction. Yeah.
And it's a seller's market. I see this over and over again, where sellers have got properties that really, in my opinion, are not worth the coin that they're wanting for those properties. But they say, what am I going to do with the money? So I might as well just keep it. If somebody comes along and is prepared to pay a 4% or 5% yield on the property, sure, I'll sell it. But there's no motivation for them to be selling right now. The motivation is
where are they
coming
going
from
to
the
put their money?
buyers, and as a result, well, good question. Yes,
If you sell
most of
what
them
you've got, well, you got to put your money somewhere else, into something
yeah.
else, and what's the options, So it's it's really interesting how that's sort of working. And I guess, for the most part, I think in some areas there's that underlying sense that the market is still going to do well and perform well, depending on what area and stage and that you're in. But there's an underlying sense that there's more to go. So, people are sitting tight.
I do believe that there's a lot more to go. And if Philip J. Anderson's got anything to do with it, I don't know if you know who Philip J. Anderson is. He's one of the very well-known Australian economists in property, and he does the 18.4-year cycle. He's saying, if you've got cash right now, be aggressive and buy as much as you can, because we're in the second phase of that cycle. So, and I guess that's exactly what people are doing. is if you got the cash, you want to be spending and you want to be buying it. I mean, I'm dealing with a lot of clients that are looking at 5% properties, and I'm saying, if there's longevity in it, it's a no-brainer. It's worth still putting your money into it because you've got an asset that's going to grow and you've got an asset that you can add value to ultimately. So
well, that's a win if you can add value to it as well as
yeah.
get the growth on top. That's brilliant.
So currently, economic turbulence leads to a 30% of sellers or property owners making no moves whatsoever. So if they were thinking of selling, they're thinking, just like we've been talking about, there's no ways that they're going to want to be selling right now because where are they going to put their money? Interest rates, financial availability, major concerns. People are worrying about it. 46% of people are saying that the interest rates have impacted their buying choices. And with the rates rising from 0.25% to 1% deter 29% of buyers. That's quite a chunk. 29% of buyers are being affected by the raising interest rates. Are you finding that in residential?
Yes, I guess the answer is yes. So we saw the heat in the market, which hadn't seen anything like that before, and even a lot of people who'd been in real estate for 40 plus years, the old timers that you meet the old agents around the place, and they said that there's never been a market like that COVID period with just that much intensity. And so it sort of came off the boil there, but I mean, to be honest, it is still quite busy. The only thing that I think slowed it down is when we started to see those interest rates starting to go up, and the fear that whether it was the fear of the media sort of, these 12 interest rate rises that we sort of started to see happen over a period of time, and of course it hurt people's pocket. But like I say to a lot of buyers as well, like when we had those interest rates of 2% or whatever like that, I just don't know how many people really based their numbers on 2% and never expected it to go back to that sort of 5 or 6%, which is considered considered quite normal for a long period of time. Like it wasn't 9 or 10%, but it was reasonable. That's what we were accustomed to for a long time. So
yeah. I mean, when we got to that 4, 5, 6% up, I mean, I concur with you. We were out there saying this is not the new normal. This is what it was before the spike. But I think it's like anything. When you're having dinner, you tend to hang on to the best bite. So COVID was a little bit like that, where
the best bite.
The best bite was the spike, and everybody it was a buying flurry, which was made.
Yeah.
In this survey that they did, they asked people about just their pricing predictions, and 71.8% believe that the interest rates are gonna go up. Okay. 11.5 only 11.5% believe that they're going to come down. 16.7% believe that they're going to stay pretty much the same. So I think that is fascinating that 71.8% are believing that we still got a little bit of a way to go. I'm on the disbelief of that. I do believe that we kind of on the borderline of recession, and I don't think the Australian government wants to go into that recession. So they're going to be holding back and doing what they're doing. And if you see what's been going on in America, Australia follows suit. Australia is kind of like the baby brother of what's happening in the US.
Yeah. Look, I think. Sorry, I thought that related to property price prediction, whether they thought that was going to go up or down. But look, I mean, talking to a number of different brokers, and the general consensus is that they think that interest rates are going to go down from what I'm hearing.
Yes.
And look, I think that's probably just going to start. It will bring that sort of market sentiment up. People will be more positive about buying again. People will start to come back into the market because that's sort of what happened last time too.
Yeah, you're right. The statistics that we're talking about are price prediction. So 71.8% do believe that the prices are going to go up, which is a great place to be, because if you're buying now and your prices are going to go up, happy days, you're going to be riding the wave.
It can almost, that's a really positive, um, prediction or market sentiment, and I guess sometimes that can be self-fulfilling as well. Like that. If everyone's believing that, everyone's going to be buying or trying to buy at least, as long as they can get the finance. And if everyone's trying to buy it like they are, there's a lot of buyers in the market, that's going to push property prices up.
Well, I think that's exactly what's happening right now is people are looking at it, and I'm seeing more and more people coming into the market that just they kind of feel as if they're missing out. Fear of missing out, and now's the time to get in. So current Australian property market sentiment, 49.8% positive, which is, again, it reinforces what we were saying earlier, 20.3% negative. That's 50% of your 40% positive, and 29% neutral. Very interesting figures. Interest rates and the RBA, the statistics and review, 47% are believing the RBA received negative ratings. So that's I'm not surprised. What about you?
Look, I think you got to blame. Well, people have got to blame someone, and when there's 12 interest rate rises in such a short period of time, I think it's sort of unavoidable that the RBA would have got unavoidable that they wouldn't have got some negative reviews.
Of course.
Nobody likes interest rate rises, and so, especially 12 of them.
No, 12 of them was quite something. But then again, what did we expect? We had how many? I think we had about 8 interest rate cuts that pushed us to the reverse of that, except we went a little bit higher than the 8.
It would have been really interesting to see what the rating was when we had the 8 interest rate cuts, whether it was like 40% that the RBA was doing a great job, that they're fantastic. I just wonder.
Yes, probably the RBA wouldn't have got the kudos for that. I think the governments would have got the kudos for that.
You've got to blame someone, like I said, right?
Yeah, absolutely. The statistics are that 3.7% think that their performance was very good, and I'm wondering whether that 3.7% actually works for the RBA or if they've got some sort of invested interests.
A paid vote, you reckon? Or
maybe a paid vote.
Yeah.
There we go.
Yeah.
You said it. Look, the good news is that I think if anybody is buying property at the moment, currently, they're doing the right thing, in my opinion, because you can see from these statistics that I think we've still got quite a long way to go. We've still got that growth, and with such a demand and so many buyers and cash in the market, it's a no-brainer. That you just continue doing what you're doing. I've had quite a lot of news of people saying, they're concerned about it being a bubble. Well, you've got to take the ups with the lows, and I think the big thing is leverage. Don't leverage yourself too hard, so that you can actually afford the property if there is at some stage, a bubble.
It's always, it's never just a straight line, right? It's there's always ups and downs and flat spots and stuff like that. And we've seen some good growth. We've seen a bit of a dip if we're talking, I guess, specifically about Brisbane at the moment. If we're just to say that, we've seen a bit of a dip, and probably for a lot of parts of Australia, we've seen that sort of dip. But we've also started to see a bit of a rise again, and it's just that up and down. And property, for the most part, it should be an asset that you sort of think about with a longer term view, not like a shares or something like that, where it's maybe a shorter, transaction sort of period.
Yes, and you're going to get your ups and your downs, and you just got to ride the tide. And I think the big thing is it's a matter of money management. Your your own finance management and making sure that you try and pay down as much of those debts as possible while you can, put as much as it in as possible.
Yeah.
And with us being where we are in the market, don't leverage too hard, because I think that's where people come unstuck. And
Yeah.
that's pretty much what we've seen post-COVID, where they've been on that fixed 2%, and now suddenly they're paying 6, 7, 8%. And they've got a host of properties that they're trying to hang on to, which I would suggest that they do try and hang on to if they possibly can.
Yeah, like I think people have to be smart. I mean, if you went in at 2% and you thought it was never going to go up again, I mean that was madness. But also like you said, creating those sort of buffers and allowances for those ups and downs in the market, and paying down as much as you can.
Yeah.
So you got that buffer in place. But I mean, these stats are pretty interesting here, and we say this a lot to our landlords, like we do some property management as well, and like I think it's always better to hold on to a good tenant and like give them those sort of rental increases so they're still around market rent, because when you try to change over tenants for like the sake of $10 or $20 a week or a small amount, you're going to have those vacancy periods. You're going to have reletting fees. You're going to have maybe some
Marketing
maintenance or
fees,
cleaning costs,
agent fees.
and
Yeah.
it all sort of starts to add up. And now you're for the sake of let's say for residential, $10 or $20 a week, for an extra couple of dollars, you're now thousands, maybe $1,000 or $2,000 down from loss of rent, from that vacancy period, marketing, letting fee, all that sort of stuff. Like it could be $2,000 down. You're better off just keeping that good tenant.
You said it. And the statistics are out of the report are landlords willing to lose a good tenant to pursue the highest possible rental return? 68% very wisely have said no, whereas 32% have said yes, which I find quite fascinating. So you just got to make sure that you're not in the bracket of the 32%, because realistically, as you said, Mark, for a couple of dollars, you end up losing more at the end of the day. So look after what you have.
If they're good tenants, if they pay the rent and look after the property, I mean, what more can you ask? I mean, bring the rent up if it's a little bit low, bring it to where the market should be. But
sure, do your market rental reviews as you need them when you need them. But
absolutely,
hang on to the gold. If you've got them, look after them.
Yeah, that's right.
So
it's a two-way street.
It is, and I often say to my clients that your tenants are your business partners. Look after your tenants, and they'll look after your business. They'll look after your interests. And
absolutely.
within reason, market rental reviews, rental increases, whatever it is, yes. But if it's happening all over, it's expensive for them to move, and it's expensive for you to re-tenant. So look after them.
I've had personally, I've had two properties where tenants have been in since the day that I bought them, and that's been over 7 years. And like we've brought the rent up in line with market each time, and we've looked after them, and they've looked after the property. So I mean, it's worked really well.
Yeah, well, you're obviously a good landlord to have, so that's a good thing. Likewise, we try and do the same thing. Interesting, this little statistic on households under mortgage or rental stress. We've still got, it still looks fairly positive by saying 50%, 56% are saying no, where 36% are saying yes, 8% are saying unsure. So it's just an interesting question, I think, that they're asking. Now, we were talking about the build-to-rent space a little bit earlier, and I mentioned I don't know too much about it because it's very much a residential space, and I think you don't really play much in the game.
No.
But I think it is something very interesting that is in the market, and for developers in particular. And to create space for people to buy their own homes while they're renting their own homes.
Absolutely. And look, I think, the government's trying to do what they can do because we do have a shortage of new properties being built. Um, and we're seeing that in the when people are going to buy properties because there's such a demand at the moment. There's still, we've still got low vacancy rates, from what they traditionally were. Like there is a shortage out there still.
I think government perhaps would like to do something about it, but I think local councils have got they've got way too much power in holding the ropes back. I've got a lot of development people and friends and clients that we deal with, and it just blows my mind the red tape that they have to go through in order to provide housing. It's ludicrous. It's crazy. It's pen pushers at the end of the day. They're just moving, ticking boxes. It's
and
annoying.
It's expensive.
Hell yes. Big time.
I mean, if it's not profitable, a developer's not going to build it, right?
Yeah. Yes. And often the developers don't know how expensive it's going to be because they don't know how many box tickers they're going to run into along the way.
So, it's a nice surprise.
You might think so. This is an awesome survey on the respondent profile. Let's just go through this. We've got 41.5% seasoned investors. That's 41.5% out of the 735. I suppose that's pretty expected because they are property investors and people who read these kind of magazines and are on these profiles are property centric. So let's just read through what we've got here. We've got seasoned investors, 41.50%. You've got owner occupiers, 31.97%. First time investors, 10.75. Well, I think that is a huge jump. I can't say from when and what it was, but I think that's a huge increase in what it has been over the past couple of years. Then you've got your rent investors, which you were talking about earlier, is your 6.67%. First-time home buyers, I think that's pretty low, but I think that's the barrier to entry that restricts people, which is only 4.9%. Then you've got your renters. Again, I think that's incredibly low at 2.72%. And then others, which would be everybody else that doesn't fall into those categories. I think what was most interesting for me was where most of these statistics are coming from. 34%, guess where? No brainer.
I can see it. So I'm cheating. New South Wales.
You're cheating. New South Wales. Surprise, surprise. I think New South Wales has always been the capital state for investment properties. A bit of a surprise, Victoria, 21%, and then Queensland hard on the tail at 19%. And I do believe that that's probably gone up in the last 5 years. And then you've got 9% in WA, South Australia 4%, Tasmania, ACT 8%, not too bad for such a small area. And then no surprise, most being male, 57.7%. And I think a lot more women have come into the space at 42.3%. Well done, women. Keep it going.
Interesting to see the age groups there as well below that, where it was a lot of young investors, 25 to 34. I would have thought it possibly would have been the next bracket, which would have been leading the way, or the next two, to be honest. But a lot of young investors, a lot of people getting in early, which is great to see.
You're quite right. I kind of skipped over that, but I think it's interesting that a lot of young investors are now sitting up and starting to say, hey, but I think a lot of those investors probably had mums and dads that have been invested, so previous generations, and they're starting to see where the wealth is coming from and organically going into that. So it's good to see. It really is good to see. I mean, in our generation, my generation, it just wasn't heard of. It was sort of an anomaly if you own 2 or 3 properties, investment properties. So it's good to see that the young are setting up and getting serious about their investments. And then absolutely. 35 to 24, 23%. Yep, good stats. Let's talk about sentiments and projections. The property prices rebound in most capitals, erasing annual losses. So, I mean, the prediction is that if you're buying in the capital city, you're always going to make, that profit. However, years ago, you did have capital cities that did take a little bit of a slump. And I mean, we just need to have a look at what's happening in Victoria, in Melbourne, where, as a result of COVID, they've hit quite a reverse in their demand. I do believe that is coming back, and it will come back. So it's what I always say: when you have an asset, when you have property, you will always find somebody to rent it, no matter where it is and what it is. It's just a matter of time, place, and how you deal with it. It's not what you have; it's what you do with it.
Mm.
Generally, Australians are very positive about the property market. I don't know how you're going with bank lending, but to us, it's a very I kind of feel that it's very uncharted territories, because the banks are changing their lending rates, and never mind their rates, but their policies and commitments. We have a lot of changes. So if you are getting any bank approvals at the moment, I'm saying get them in writing. Because seriously, they're changing resources, they're changing personnel, and they're changing their minds as fast as they can blink their eyes. So
Yeah,
get
right.
it in writing.
Well,
Um,
we haven't had too many dramas. Maybe it's the commercial versus residential sort of thing. But a lot of our clients are, we make sure that they're pre-approved and stuff like that. So getting it in writing, like you said, is always a good idea. I think no matter what's happening in the market. But yeah, it's
correct.
interesting. These concerns. I think these things really, with that market that sort of just skyrocketed. These were the things that really pulled the market back. Like the interest rates, like we spoke about before, the interest rates going up, and the mortgage, fixed rate mortgage cliff, also put a lot of fear into people.
Hmm.
But for the new build for house and land stuff, that has really stopped a lot, because I mean, people were so nervous about the cost of building, because you'd hear these stories that they'd get a contract at this price, but because the materials kept on going up and up and up, the end price was sometimes 50, 80 grand more than what they started with. So I mean, that made a lot of people nervous. Builders going, not being in business anymore, and fear of going bankrupt and stuff like that for some of the builders. So a lot of people have really backed off from building, which if they're not building their home, then they're buying back into existing. So puts extra pressure on that existing market. But those things, yeah, I think those things did slow down the market.
Yeah, they most definitely did, and we probably needed to slow down the market. Otherwise they wouldn't have done it. But high inflation affects property
Mm.
markets, transactions, all of that. And yeah, you're 100% right. And I've seen quite a lot of that, where people couldn't afford to purchase their houses, and they've been stranded as a result of that. The benefit is, and they always say, one man's loss is somebody else's treasure, where somebody else who's cash rich comes in and snaps up those properties that are half built at a fraction of the price, puts their own builders on it, and happy days. They're churning out a property. Obviously, it's over a period of time, but again, a great investment property that they can do that. And again, if you've got cash right now's the time to be buying. And these opportunities are around. I see them in commercial, and you probably seeing them in residential as well, like what you're talking about.
I always keep in the back of my mind that Warren Buffett saying, and I know a lot of people know this and that, but it just happens over and over again. Buy or be greedy when everyone's fearful, and be fearful when everyone's greedy. And so when move against the current, like it just happens over and repeats itself over and over again. Such a true statement.
It certainly does. It most certainly does, and it takes me back to thinking about the market report that I've been reading of Philip Anderson. Exactly the same thing. You know, he concurs with the Warren Buffetts and the Ray Dalios. And the interesting thing is that all their cycles are very much the same.
Mm.
He might be more in property, but the economic cycles are all the same, no matter which which area you're looking at.
Yeah,
Um,
absolutely.
there's the little chart that I'm looking at the moment is affordability concerns and how the market has responded to it. And there again, I mean, you have a look at that massive spike from 2020 right through 21, and it
Mm.
started to ease off in 2022. I think that third quarter is where maybe the biggest interest rates really started impacting on people's pockets. However, we're getting used to it again, and it's going back up in the fourth quarter of 2022 and
Mm.
into 23. Um,
Yeah.
Although it's come down to probably about 12, what's that, 10.5% in the second quarter of 23. And that's probably, I don't see where it's come down because I think people are still out there,
Mm.
buying like crazy. But depending on the sector, the affordability concern could be probably I would think mainly the housing market and owner occupier more so than investor.
Yeah, there's like you said, there's still a lot of people out there wanting to
Mm,
buy, so they're not too concerned about the affordability side of things. I think one of the things really keeping the market going is just the lack of supply. I mean, there's just
yep.
when there's more people, you know, competing against each other in the same property, pushing up prices, whether it's at auction or in a multiple offer. Um, it's got if you've got more buyers and sellers, you're going to have the market moving forward.
Absolutely. And it's like that in any industry. It really is. This is a lovely little question. Should banks relax lending rates?
Should the answer always be yes?
Well, hell, it doesn't matter how low the interest rates are. I would say, hell yes.
Just
I,
let me the money.
for sure, show me the money, give me the money.
That's it.
Why would 24% say no? Are they bankers? Are they
Yeah,
are they on the inside track?
I know that's a big number though. If 24 people percent saying no.
Yeah. Should banks relax lending rates? 24% are saying no. Okay. I'd love to know why. But
That's probably a good follow-up question. Why are they saying no?
the good thing is the positive property market sentiment has really been on the up in, 2021, we had it up there close to 70%. And it's still driving at 50% currently. So
Mm.
still a lot of positivity in the market. And I think it's going to continue for at least another few years.
It would have been interesting actually to see. So that was the first point there is quarter 3 of 2020, and it would have been interesting to see what the first and second quarter was because that was the very start of COVID. And I just remember buying then, um,
Yes.
and it was just like people were just so scared. Like, and probably we got some amazing deals because people were
Deals,
like
yes.
would sell because they're like the sky's falling, like this is the end of the world. Like that was what was happening in some cases, and they just dropped prices by 100 grand. I remember one house that every day of the week it was at the time like a 320 house. They sold it for 220. Um, and there was a great
Wow.
property, but they just were just like, we need to get out.
And if I think back, you're 100% right, because exactly the same thing was happening in commercial, where we bought properties at that time, uh, properties that are probably worth around about 3 million. We bought for just above $2 million. So you know, residential, you're talking about 100,000. That's a huge drop when you're looking at 220 versus 320. And in commercial, again, like for like, 3 million down to 2
Mm.
million. So it really was, it was an awesome time to be buying. And I think that's exactly what drove that third quarter to the fourth quarter from
Mm.
35% right up to 65%. You
But
know,
I don't know about you, but I definitely remember that sort of point, that sort of third quarter, that it was just like people, we're still doing lockdowns and that, but people were like, right, let's go. They're like,
Mark,
we don't care what's going on, and the market
yes.
was took off.
I even remember the dates of properties that we were settling through that period because it was just unbelievable.
It was just
It was,
growing. Like it's just
yeah,
overnight.
yeah. In that between March, August, September, it was just like, if you could get those properties and drive them, there we go, happy
Mm.
days. So I
Yep.
think probably we can't see what the sentiment was before that, but I'm assuming it was probably around about that 40 odd percent. And if we have a look at where we are at the moment in the first and second quarter of 23, we're between 40 and 50. So
Mm.
again, it's kind of balancing out, although we all know that there's still such a radical shortage of stock. So what's the moral of the story? Let's keep buying.
Let's keep buying, and from what the next slide says, keep buying Queensland. It says.
The Queensland is a great place to live. So there's no doubt about it. And I think as a result of COVID and the way that things were handled in COVID, we had such a lot of interest that came. Not to
Mm.
mention that right smack in the middle of it, or was towards the end of it, Queensland got the Olympic bid. So happy days.
That helped a lot as
We've got a
well.
lot of
Yeah.
drivers that are happening. You know,
And look, I mean,
um,
obviously it's residential property, and we've always had interstate migration. Everybody wants to live in the Sunshine State, when they retire and move to the beach, and it's, I guess people really started to realise that they could sell their homes in Sydney. Zoom calls become a lot more commonplace and acceptable, and people could work from home. So they're like, well, I can still work my Sydney job, sell my house, have $500,000 cash in my back pocket, and buy a better house in Queensland. So a lot of people did move for that sort of reason. But as owner occupiers. But I mean, now I think Queensland's still, like you said before, the upcoming Olympics. We've still got, good solid rental yields in Queensland. I mean, obviously competing with WA and Perth with that. Perth's obviously a little bit higher with the rental yields. But,
mm.
I think people sort of went more towards Perth a little bit, and then they're sort of coming back towards Brisbane. I think they possibly might see it better longer term growth, maybe.
Do you purchase any properties in Perth?
Look, we're always looking around. We've done a few things over there. Yeah, we've not as much as Queensland, but
Yeah.
yeah, we are looking over there. I guess when people ask me, um, I say Queensland, and it's not because I'm based here. It's because I think it will perform better than Perth in the long run at the moment. But if people want to diversify and buy Perth, if they've bought some stuff in Queensland, or if that's what they want to do, yeah, go for it. But
Happy days.
personally, my opinion is, in that affordable, if you're not buying, New South Wales or Melbourne,
Yeah.
and a lot of people aren't, but the yields aren't there. The numbers aren't making as much sense from a cash flow point of view, in residential at least.
Mm.
Then the next best market, which will also get some growth, is I think is Queensland.
It is most certainly. And it's interesting you saying that because we've been, for the last 2 or 3 years, I've said we won't touch Victoria. Now what's happening is I think there's been a little bit of a drain in Victoria, and we're starting to see those 5% properties that were traditionally
Yeah.
4 and 5%. And Victorians are accustomed to buying properties at 4 and 5% on the commercial side, whereas in Queensland we're accustomed to buying properties at 7% yields. And I'm talking
Mm,
about net yields. And we
yeah.
started to see a couple of properties, investment properties in and around Victoria, not necessarily in Melbourne itself, towards that 6 and 7%. So I'm looking at it and I'm saying, okay, Victoria's been through the slump, and again, it's that cycle of ups and downs, where all investors are saying, oh, let's draw our money out of Victoria. We're not going to be buying in Victoria. Well, now, as a result of that, we're starting to find better deals coming into buying in Victoria. So it's right
a lot
at
of
the
people have got
start.
their eye on that.
Yeah, it's sort of right at the start. But I think it still has a little bit of a way to go. But it's there. It really is. This was a statistic on their report of which state offers the best investment prospects. Now, bearing in mind that this was done probably about 3 or 4 months ago, and everybody's saying all eyes on Queensland, 31% on Queensland. And it goes back to exactly what you were saying earlier about Queensland, the Olympics, people wanting to move up to the Sunshine State, people being able to work without,
job
wherever, work from home.
Plenty of job opportunities.
Massive job opportunities.
A lot of infrastructure spending. And when I guess, when I'm talking to people about the Olympics, a lot of people will say, oh, the Olympics, it's 2 weeks, going to put a spotlight on Brisbane and this, that, and the other. And look, maybe there's some of that too. But for me, what the Olympics actually means is it's going to create a heck of a lot of jobs in the lead up to that. It's not about the 2 weeks, it's the next sort of 2, 3, 4, 5 years leading up there, because we need to build venues and stadiums, upgrade transport and roads. That's going to create so much, a whole bunch of jobs. And we've already got a shortage of accommodation to both buy or rent. And if you've got all these other people moving up and there's not a big supply, because then there's not a lot of new developments or anything like that, where are these people going to go? What's going to and then what's going to happen with property prices and rents of properties? Are they going to go up again? That's my opinion.
And I think you're spot on with that. I think you're 100% spot on with that. I mean, very nicely put there, Mark, because it is all about that infrastructure and jobs, and you just need to have a look at what's happened in the other states. History repeats itself. Queensland hasn't gone through the same sort of gentrification that, let's say, New South Wales has or Victoria has. So, and now Queensland's,
feel like we're right on the cusp,
20 years
right?
behind. Yeah, we are. I reckon we're catching up very fast, and never a bad thing. I think it's a good place to be. And in comparison to all the other statistics, Queensland's a big area. There's a lot of catch up to be done, and I don't think it's going to be slowing down anytime soon. As you say, a lot of people are saying, yeah, boom and bust. It's going to be a big driver up to the Olympics. And I've heard a lot of people quoting what happened in Sydney. Was it the 2000 Olympics, where where there was a big drive up to the 2000 Olympics, and then there was a little bit of a stagnation. I really don't think that's going to be happening in Queensland. I don't think it can be compared to that, because different time, different economy, different state. That offers differences. I really think there are a lot of people that will be moving to Queensland. There'd be a lot of use out of the stadiums, out of the buildings, out of all the infrastructure that is being created in Queensland after the Olympics.
And it may also be with people coming to the state as well, especially if they're coming from somewhere like New South Wales or Victoria. And they move to Queensland, if they get accustomed to it being a much more affordable place to live, it possibly might be difficult for them to go back to one of those two. Maybe not if they came from SA or WA or anywhere like that. But if they're coming from New South Wales, I mean, the cost of rents, people don't tend to go back. It's difficult.
No, they don't. No, they don't. I mean,
why would you? We live in this beautiful place.
Exactly. Now there's
a little bit biased, like you said before, though, right?
Yeah, well, excuse me for being biased, right?
Yeah.
From an investment point of view, I think you need to open, we need to open the channels and have a look at where those investment bubbles is. Because to be quite honest with you, yes, all eyes on Queensland, and this is where investment prospects are, which is general. But there are a lot of smaller, I want to call them almost pop-up areas that are all around the country, you
Mm.
know, in other little areas. And these statistics, we don't have that on hand right now, but it might be interesting to have a look at that at a different time, to have a look at where those top 10 or top 20 areas are that have just sprouted, as a result of
Mm.
various different situations and circumstances. But in general, yep, Queensland. And again, what does Warren Buffett say? Be fearful when others are greedy, be greedy when others are fearful. So we're watching this
Mm.
Queensland market very, very closely. And that's why I say I'm looking at the Victorian market now and saying, well, I think it's starting to turn.
No one's playing
Um,
in that space. It's been a bit of a non-event for a while now. It's yeah, I agree. I think a lot of the smart investors are sort of starting to keep an eye on it, a close watch on it.
Last little thing we're going to have a look at over here is in what capacity will you purchase in the next 12 months, was the question that they asked in the survey. The biggest was 50% were investors. And this is massive, that 50% were investors saying that they're going to be looking to purchase in the next 12 months. So there we go, guys. If you
I
are thinking
wonder
about
though.
investing,
I wonder if that's maybe a little bit skewed. Like because that pool of people that they took it from, 738,000.
yeah,
I'm doing what you do. 730 people, or whatever it was. Uh,
735 people, right. Let's get our
35
numbers.
people.
Yeah,
Oh my goodness.
they're
Anyway,
property investors.
th- are they the people who read the magazine too, or was it like an independent survey? I mean, this would probably indicate they're probably people who read the magazine. 50% being investors.
Well, that's why I think it's quite biased, because these are people that are interested in. I would think we'd assume that these are people that are interested in property, and I guess the best thing would be to actually interview somebody who's actually put this report together. But
Mm.
just from the outside, um, the data and their responders are their readers, I would imagine. So yes, it probably is pretty skewed that 50% would be investors.
Yeah.
It's interesting that out of their readers, 22% are saying not applicable, that they, neither here nor there.
The fence sitters.
And fence sitters, there we go. Yeah.
Yeah.
Uh, um,
Yeah. Very
but
good.
either which way, I think people are really on the up of of. I've noticed far more people coming into the market and looking to buy properties and looking for investment properties.
Oh,
So
absolutely.
the
Yeah.
types of assets. I mean, this is interesting because I was interested in the commercial assets. We've got 36% on standalone detached housing, 20% on townhouses, and probably goes back to what you were saying about supply and demand and affordability. That figures, I reckon, gone up. Units and apartments, 19%. I thought that was pretty high.
Mm.
So that's interesting.
Yeah.
9% in commercial, that's definitely come up quite
That's a
substantially.
good number for commercial. I think that's a
That's
quite
a
a
massive
good
number for
solid number.
commercial. Yeah, that's a big drive. And there again, that goes back to my 53% of buyers versus lack of stock. You've
Mm.
got 53% buyers and you've only got about 20% stock on the market. So there's such a huge demand on that stock that is on the market. Hence the price is being driven up. Vacant land, so people that are building, rural, 5%, and other would be, everything else in the kitchen sink, 1%. Um,
Interesting.
but great statistics. Yeah, Mark, it's been great having you chatting about all these statistics. I think there's a lot more that we can talk about. There's fantastic statistics about regional versus cities. I'd love to do. Um, but we can't do everything all at once. So maybe that one's for the next time.
No, it's been a lot of fun, and thanks again, Mish, for having me on. I really had a lot of fun, and it's been great chatting.
So, guys, if you would like any information or to see the property report or anything further, reach out to us at revolvecommercial.com.au. We have a great Facebook page, and we've got lots of links that will take you on a property journey to see whether you qualify for a property. We've got lots of freebies on the website. There's a VIP list that I put out every single month. And in fact, I was doing it this morning, and wow, I've found some incredible properties that I'm going to be putting on the VIP list. So if you're not on there, jump on.